Oil and gas investing. IDCs, depletion credits, non-operated working interest. If those words just made your eyes glaze over, then just stay with me for a little bit, okay? What I'm about to break down could be the most tax-efficient, cash flow positive, inflation-resistant investment strategy that most high earners have never actually had explained to them clearly enough to take action on. And today, I'm covering why smart investors are moving into oil and gas, exactly how they are doing it, and a few things that I wish that someone had told me before I started investing in oil and gas. All right, so let's start with why. There's three main reasons that sophisticated investors keep coming back to oil and gas investing. And the first one is the one that your financial advisor really does not want you to know, because if you did, then it would cost him AUM. Here it is. The tax benefits are unlike almost anything else that's available to high-income accredited investors. And here's a quick breakdown. Now, when an oil well is drilled, there are two buckets of costs involved. The first is intangible drilling costs. These are things like labor, fuel, fluids, hydraulics. And then there are tangible drilling costs, which are the physical equipment. Now, the IRS treats these two types of costs differently. Now, intangible costs typically make up about 70 to 80% of total drilling costs, and they're largely deductible in the year that they're incurred. The tangible costs get depreciated over time. And on top of that, there's something called a depletion allowance. As the well produces and the resource depletes, investors get an ongoing deduction that reduces their taxable income year after year. Usually, what that depletion allowance means is that the first 15% of the cash flow that you generate comes to you completely tax-free. The best part of this is that as long as the investment vehicle is structured in the right way, those deductions and tax benefits can offset earned income, not just passive income, but earned income. So let's say you make $300,000 a year active income, and you invest $100,000 into oil and gas. Get, say, an 80% of that as a deduction in the first year. Well, that brings your taxable income down by $80,000, saving you close to $30,000 in taxes before you even consider the actual return on investment. And for a high income earner, that's a very different conversation than what most investments are able to offer. Now, the second reason that I invest in oil and gas is the cash flow. And it comes fast in most cases. Oil and gas wells, especially new drilling programs, can start generating cash within 1 to 2 quarters of the capital being deployed. And so that's not a 2-year 3-year, 4-year hold waiting for an exit. That's actual distributions that are hitting your bank account while the asset's still being built. So our funds, for example, have paid anywhere from 15% all the way up to 35% cash flow in the first year. So that $100,000 investment example I mentioned earlier that already saved you $30,000 in taxes also made you up to $15,000 to $35,000 in cash flow the first year. Or, you could just put it in that mutual fund. All right, the third reason that I like oil and gas is the inflation hedge. When oil prices go up, nearly everything else gets more expensive to operate because energy is an input cost for almost every business on earth. And that means that when inflation's running hot, oil and gas assets tend to perform well at the exact moment that most of your other investment holdings are getting compressed. Now, it doesn't perfectly offset everything, but the correlation is genuinely opposite to most traditional assets, and that really matters for modern portfolio construction. Now, let's talk about how smart investors are actually doing this. Because you're like, Caleb, all this sounds really good, but how do I invest in oil and gas? Well, the structure here matters enormously. The two approaches that have worked best for me are both through private funds. And I'm not giving investment advice. I'm just telling you what I've done and how it's worked. Now, these two different approaches they serve slightly different goals. Now, the first approach that I've taken is investing in funds that buy existing production. These funds acquire wells that are already in place and are already producing. It's called PDP, proven, developed, and producing. The cash flow from that existing production in those funds then gets used to fund new drilling opportunities. So think of it like a self-sustaining flywheel. Now, the trade-off here is that the front-end tax deductions are usually a little bit lower, and the early cash flow is typically a bit more modest compared to a pure new drilling fund, but what you get in return is a longer-term compounding income stream that's building real exit value. You're actually building something. And every quarter that cash flow comes in, the underlying asset base actually grows. That's a very different energy than just chasing a single outcome. Now, the second approach that I've found to be really successful is investing in new drilling programs through non-operated working interests. This is where the tax advantages get a lot more aggressive. I'm talking 70 to 80% of invested capital deducted in the first 12 months if you're in the right structure. And the way this works is you're investing alongside established into funds that invest and acquire non-operated working interests alongside of middle to large market operators, companies with proven track records that have strong balance sheets, companies like ConocoPhillips or Continental Resources or Chevron or Marathon. You're not having to operate the well. You are a working interest partner in the drilling program. And one thing that I look for specifically in these funds is horizontal drilling programs. See, horizontal drilling compared to vertical drilling, it substantially reduces the risk of a dry well. Now, the technology for horizontal drilling has gotten good enough that when you're working with a quality operator in a proven basin, the risk profile looks very different than it did even 10 years ago. We're talking 90% plus success rate. Now, the cash flow in these structures typically starts within a quarter or two of deployment, and the tax hit in year one can be meaningful enough to change your effective tax rate for that entire year. So, lastly, here's a few pro tips. These are a few things that I think about that a lot of people skip over. And again, none of this is advice, by the way. This is just one man's opinion, okay? Number one is diversify across wells, across operators, and across funds. Concentrating everything into one well or into one operator is an unnecessary risk. The whole point of a fund structure is that you get exposure across an entire drilling program. But I would take that further. Spreading across multiple funds with different operators in different basins makes this a much more resilient part of your portfolio. And the reason this is important is because if you invest all of it into one well or all of it into one operator and one drilling program across multiple wells, then if one of those wells doesn't work out, it's a dry well or it has some liability claim or something like that, then that can wipe out the entire return. But if you invest in a larger fund that is deployed across multiple different drilling programs with multiple different operators, then you diversify that risk. And if one underperforms, the chances are that you'll have another one that'll overperform. So the second pro tip that I would give you is pay attention to how you're classified as an investor. I like to look for funds that allow me to invest as a general partner at first, with the option to convert to being a limited partner down the road. Now, that may sound like some small structural detail, but it really is not. It's extremely important to me because investing as a general partner is typically what allows you to use the tax benefits against earned income, which is where the real math changes on your tax bill for high income earners. But the ability to convert to a limited partnership structure later is what allows you to limit your long-term liability exposure once the heavy tax deductions have already been taken. And that combination, GP on the front end, LP on the back, is usually how the strategy is designed to work best. And lastly, keep perspective on where this fits inside your portfolio. I mean, obviously, I think oil and gas is a genuinely strong piece of a strong portfolio, but I'm never a one-trick pony. The best outcomes that I've seen come from stacking multiple uncorrelated assets. The reason that private alternatives keep showing up in that conversation is simple. Public markets are almost entirely driven by macro narrative and sentiment right now. When the Fed speaks, everything moves together. That's the opposite of diversification. Private alternatives, things like oil and gas, real estate, private credit, they move more on fundamentals: supply, demand, cash flow, and contracts. That's what real diversification looks like. And for investors at this level, that's where wealth actually gets built. Now, real quick, because I know this comes up, someone in the comments is going to inevitably say that oil and gas investing is irresponsible, that we should be putting our money into clean energy and moving on from fossil fuels. And I just want to address that directly with actual numbers, because I think conflating your investment strategy with your identity is one of the most expensive mistakes that an investor can make. Here are the facts. The IEA projects that global oil demand will not peak until 2029 at the absolute earliest. And even after that peak, demand does not fall off a cliff. It plateaus. We're talking about decades of continued consumption at levels that the world has never seen before. Global energy demand grew by 2.2% in 2024, the fastest rate in over a decade. And renewable capacity, which did grow substantially, still only offset about 30% of that new demand. So the other 70% of new demand was met by fossil fuels, not because governments wanted it to be that way, but because that is what the physics of energy transition actually looks like in reality and in real time. Now, the United States exported a record 10.2 million barrels of oil a day in 2024. That was a record. In the middle of the most aggressive clean energy policy push in American history. So the idea that oil is a dying asset class, that it's archaic, is not an investment thesis. It is a bumper sticker. And listen, I'm not here to tell anyone what they should care about. Care about whatever you want. But we cannot let the identity politics that some purple-haired Starbucks employee ascribes to inform our investment perspective. Those are two completely separate conversations, and mixing them up is how people make emotional decisions with their financial future that make zero sense in reality. When you're making decisions about your money, the main question that matters is whether the underlying economics are actually sound. And by every objective measure, they are. Now, I'm not saying invest against your conscience, but I'm saying to not let your conscience drift so far outside of the real of reality that you become some utopian idealist rather than someone with a real brain that you actually use. The world runs on energy. That's not going to change in your investment horizon. And the investors who let cultural sentiment override fundamental analysis are the ones who end up watching other people compound their wealth while they wait for a transition that is moving a lot slower than the headlines suggest. Invest in solar too if you want to. I have nothing against it. Just make sure the decision is coming from your portfolio strategy and not from whoever's making your coffee. So if this is a strategy that you would like to dig into further, or you're interested in learning more about how you could invest in the types of opportunities that I'm investing in through private oil and gas funds, just click the link in the show notes or the description, and we're going to hook you up. And as always, smash the subscribe button if you want to keep building a portfolio that makes sense regardless of what the market's doing. A portfolio backed by alternative assets.